Hello, everybody, and welcome to another exciting episode of The Middle Class Investor. This is Seth Martin, your host, and it is April 10th. It's about 10 o'clock on Sunday evening, and I was watching a lot of the Masters this weekend, so I couldn't find 30 minutes to talk about the markets, so I waited until the evening and the house got quiet. So what we're looking at here is a chart of the S&P 500, and we've kind of been talking about this rolling topping pattern, which looks very ominous, and it's very large. Generally speaking, the longer it takes for a pattern like this to develop, the longer the result lasts. So just in terms of odds, I would say that the odds are that the market is in some sort of process of rolling over. Although there is a possibility, I was talking with someone the other day about this possibility. There is a possibility the market is in a pattern, and we may have to go to a smaller time frame to show you this, that could lead to some higher prices up here around the top of this trend line. In this area right here. But, to me it seems like that's a lower probability situation at this point. And I guess the best way to show that is maybe go to a smaller time frame. So first of all, let's go to a daily time frame. And notice that we're right here at this trend line. And we have been making, lower, here's a low, here's a lower low, lower high so far. And also I want to point out that last week on Friday, let me zoom in on this. The market opened right about where it closed, but intraday, it ran all the way up here. And then the bears turned around and sold it off. I thought that was particularly bearish. Anytime the market, gapped up a little bit, ran up pretty good amount. This doesn't look like much, but if we kind of look at this on an intraday basis, if we look at, let's say, a 30-minute chart, you can see here that this looks quite a bit different. Right, let's see. Yeah, right. Started right here. So the market. Let me figure out which. Yeah. So this is the opening 30-minute bar right here. Now let me zoom back in. I just want to make sure I give you that we're talking about the right bars. This bar right here is the opening 30-minute bar. I'm gonna put it in red. So the close for last week was right here. So that means we gapped up. Anytime the market gaps up, that signifies buying pressure, just like gaps down signifies selling pressure. And then when the market continues, so the market opened right here, and then it continued up. So not only was there buying pressure at the open, but the bulls just kept buying, pushed the market up. And you can see we went right to the trend line and then just sold off. And this, to me, is a very bearish scenario. Now, granted, it's only 30-minute chart, but you can see this what I'm talking about right now happened after we had already sold off against this trend line. So we ran up to the trend line, pushed through it, immediately sold off, came down, rallied a little bit, gapped up, buying pressure up. We got this kind of dragonfly doji is what this is called. It's almost a Morningstar pattern where this would be like if this were happening on an open, for example, where you gap up, you run way up, and then you sell back off, and then you continue with the downtrend. That's called a dragonfly doji or an evening star pattern. There's all kinds of names for these things. It's not so much important what the name is. It's just it's what it's telling you happen between buyers and sellers. And so, to me, this is very bearish when the market gaps up, runs up, and then spends the whole day selling off. And had it not been for this bar right here, well, that's not entirely true. The market almost finished the day lower even after gapping up, which is very, very bearish. So I don't expect too many good things next week. I mean, you could still get another bounce into this area and then roll over again. The market gives up its trend somewhat unwillingly, and especially this particular market, the pattern seems so large and seems to be taking so long. And I think this is a very unique market we're in, and likely means that the sell-off is going to last longer, go further than most people expect. I think most people are expecting, some sort of 15% correction and then boom, up to the upside. Which reminds me, let me go to a 60-minute chart and then show you why there's a possibility that there could be some upside. So I'm gonna zoom in, but try not to zoom in. Yeah, I can't really get the whole thing in the picture here, but let's do it in parts. So you've got this run up right here with a pullback, and then this very strong run up, and then another pullback, and then a strong run up. It's not a perfect pattern, but it's an Elliott wave, 5-wave pattern, which could mean, doesn't necessarily have to mean this, that this was the top of that pattern. After that pattern's complete, you can get a correction into that pattern, which is kind of a 3-wave pattern. This is very typical of the market. I could show you this where this happens over and over again. And anytime you have a 3-wave pullback, then what happens is you get another 5-wave pattern, which this could be the start of. So for example, this could be 1, this could be part of 2, or all of 2. It's not entirely clear. But then you get a big 3, okay, and a 4 and a 5. So what does that mean? That means that we could take out this high up into this area right here around 2085 or so. Probably not make new highs, but eclipse this most recent high here. So who knows? I don't really know if that's going to happen. It is interesting that the market it appears to be reversing pretty much right here at the trend line. Yes, we pushed through it, but then look what happened. We immediately reversed and came back down through it. This was last week, or the week before last, and this was last week. So we could very well, get something that looks like this, and then they start getting longer, something like that, and then maybe another one, a couple up like so, and then they even get longer like this. I mean, this could all accelerate very rapidly. Now, what I'd like to talk about today, because I was talking to somebody the other day, and I'm not so sure people understand this, but there's a concept called reward to risk. And when you hear people on TV and they say they think the market's going to go up, or they think the market's got 150 points of upside here or whatever, I mean, that's a guess. You need to understand that is a guess. They don't know anything that we don't know. I mean, everybody knows the same, which is nothing. What they're actually doing is they're looking at reward to risk. They're looking at, is this area a potential area of support? And if so, if the market reverses here, what's the potential upside? And we've talked about this before, but I think the easiest way to demonstrate it is go to my NinjaTrader platform and look at, for example, a weekly chart. Actually, I tell you what I'm going to do. I'm going to look at a daily chart, and then I'm going to show you on a 60-minute basis what I'm talking about. So let me clear some of this stuff off real quick. I should have already done that. I apologize. Nothing on here is too important. Now these green things I can't erase because that's part of this indicator that I bought. In fact, let me go to a chart that doesn't. Let me put up a chart that doesn't have that. If I can find one, I'll use this DAX chart, and then I'll change it to an ES. ES is just the future of the S&P 500. Okay, so now let's go to a daily. I hope I'm not going to lose anybody here, but I think this is important to maybe let's go to a 60-minute. This is important to demonstrate. So the market tends to move from these pivots, where you can see these lines where they connect and kind of turn and go the other way. That's called a pivot. So what you do a lot of times is you kind of create a set of guardrails around the most recent pivots. Okay, so I'm gonna create a guardrail on the pivot that I clicked on a second ago, and then I'm going to create another guardrail off of this pivot right here. So these are my guardrails. Okay. I guess I've got two drawn on there. So these are my guardrails, and so what tends to happen, notice that this move down here. So let me zoom in on this. I'm going to go back and show you one before here. This move down right here was pretend like none of this is over here. This is the most recent move off of this pivot. So this is the pivot, either this one or this one. Sometimes you have to do both just to kind of see, but notice if I click on this DP off this pivot, notice how the market came down into this area and then reversed. This is very typical of the stock market. So it came down into this area, which says decision point, and it reversed and ran up here. And this happens over and over and over again in the market. And so, when something happens over and over and over again in the market, you can kind of build a system off of it. Now, it doesn't mean it's 100% right, but it does mean that you can expect certain things to happen with a certain amount of probability. So now what we do is we go to a time frame that's roughly 5 times lower than this time frame. Well, that would be about a 10-minute chart. So let me click on let me click on a 15. I'll just do it 4 times lower, okay, time frame. Notice that the current price is right in between a set of guardrails. So come Monday, we really don't know what to expect. We don't know if price is going to come down here into this guardrail and then bounce, or if it's going to come up here to resistance area and then bounce down from here. So what you do is first thing Monday morning, maybe we're not going to take a trade, for example. But let's just pretend for a moment that you're listening to CNBC and somebody comes on and let's say the market has done this. It's pulled down into this area and then it started to bounce. Okay? Now this person in CNBC might say, they may say the market is going to go up from here, okay? And they don't know if they're going to be right or not. But what they do know is that where they're going to be wrong is right here, and where they're going to get in is right here. So this right here is the risk, and you can figure out how much that is in dollars, okay? But then where do they find the reward? How do they know? Again, we're pretending that the market came down here and started to bounce. So they'll come on TV and they'll say, while the market's at, say, 2025, they'll say, oh, the market has about 3% upside, or whatever this distance is here. Market's got about 50 points worth of upside here. Well, this is why they say that. They're looking at a chart, or sometimes they're looking at multiple expansion, things like that. But a lot of times they're looking at a chart, and this is all they're looking at. Now, if they're talking longer term, then all they're doing is they're looking at a longer term chart. So they're looking at a weekly chart, forming some guardrails. Okay, so in this case, a guardrail would be here. So this would be around 2150, and then we'd have a guardrail down here at 1750. So again, let's suppose the market was at near this 1750 area, and they would start talking about, well, there's about 300 points worth of upside. So let me see if I can demonstrate that. So let's say the market came down here and was in this lower decision point area, okay, and it started to bounce. Well, they might be talking about this 2150 area as being a target. Well, how do they know that? Because they know that if the market's in an uptrend and it pulled back to support, the likely location it's going to go to is an area just above the most recent pivot, which is this area. So I just, nobody ever explains any of this stuff on TV. And so people start to think that, oh, well, this person knows, or they watch very carefully and say, hey, this person was right 5 times in a row. They must really know what they're talking about. But I want you to understand that there is a probabilistic nature to these guesses that you hear on TV, as are there here with me. So, I don't know. I wanted to explain that and try to explain it in terms of risk reward. So in the current picture, what's our likely risk area? Okay. So, it appears we're making a lower high, right? So if this is a lower high, and let's say we decide to get engaged in a trend to the downside, okay, and we decide to do that right in this area, well, then our target would be down here off of this pivot. There would be a pivot right here, okay, and so we would pick our target down here at the low. So my question is, what's the risk reward? The risk is about that, and the reward is about that, right? So you always want to try to put the odds in your favor, and the way you do that is by looking at the market and saying, okay, what's more probable? I mean, I'm at resistance here. Is it more probable that we're going to go higher here? Certainly that has a non-zero probability, but from a standpoint of trend and support and resistance and those types of concepts, the higher probability move is to the downside from here. So, and I've talked about this before, why try to get an extra 2 or 3% here when you've got 15% to the downside? So I hope that's clear to everybody, and if it's not, I mean, just comment, ask a question. I'll cover it again in more detail some other time. I just don't want to beat a dead horse here, but that's hopefully that explains that, but it could very well not. So anyway, let's look at yields. Yields are continue to confound me, but the market, that's what the market does. So not much you can do about that except just, at some point admit you're wrong. But we still have the potential for this to come down into here, as long as it doesn't take out this previous low from 2014, I think. Let me take a look at that, whenever that was. I'm sorry, 2012. So the 2012 low was 1.315. So this could pull back into this area here, where this blue box is, and bounce, and our thesis may still be right, where we think the risk is yields higher in the future, i.e. don't be in bond funds, don't be in corporate bonds, high yield bonds, things like that. Okay? And it could be that this is just a pullback and this is already the first move. Or it could be that we got to pull back a little further and then we're going to bounce. We just have to wait and see. But because of things like convexity and stuff like that in the bond market, it doesn't take much of a move here for you to lose a lot of money in bonds. That's the thing I wanted to make clear. A move up could cost you a lot, and a move down might not gain you that much. So there's some realities around bonds at these levels that have the risk reward really skewed against you if you own bonds or bond funds. And without going into a whole lot of detail, that I just want you to think of it in terms of risk reward or reward to risk. Let's look at volatility. Volatility expanded last week, as you might expect with the market being down during the week. But it did run up and then pull back. So, and notice that this is what's called an inside day. When the open, here's the open, and the close are inside the previous bar's range. So, or inside the previous open close. So what does that mean? That means if we get a bar next week that closes above this high right here, that means that volatility is probably done pulling back, and we're going to see volatility expand its way in this direction. Now, obviously if volatility is expanding in that direction, that means the market is selling off. So it's just, we're in an area where we would expect the market to either pause or roll over and go down. And but I do want to make that statement in terms of probability, not in terms of opinion. So the Dow is the kind of the one holdout, and it's already kind of looking weird because it keeps breaking. I've got this triangle here, but it keeps breaking outside of the triangle's range. And that's what I mean by it's being weird. But it is possible that this is a triangle pattern. And the way the triangle pattern, as you can see here, it tends to coil, it tends to coil up over time. And then once it's coiled up, you usually get like an A, B, C, D, E, okay? You usually get like a 5-wave pullback, and then this could break out to all-time new highs, okay? Way up there, okay? So it is possible. I don't think it's probable, but this is a very unusual looking, let's put it this way. This pattern it makes more sense as a bullish pattern, i.e. up to new highs, than it makes sense as a bearish pattern, just at initial looking at it. But having said that, the market is notorious for getting everybody on one side of the boat and then flipping the boat. So you just have to be careful. I still say that, especially if we get a close next week below this low, right? Let me zoom in here. Even in the Dow, if we get a close below this low right in here, then I would expect the market to at least come down into this area around 15,750. And if it bounces, if it begins to bounce there, and you start getting, one of these long dojis or a hammer, then it's probably a good idea to look at going long here and trading up to this 18,750 area or some all-time new high. I know that's a bummer if you're bearish and you're ready for the bear market to get kick-started, but it's still a possibility. We've got to keep it out there. It looks a lot less likely on the other markets. If you look at the Wilshire, that's the Wilshire. You can see this doesn't look like a triangle. If you look at the Russell, I'll zoom in next time. Clearly the Russell doesn't look like a triangle. If you look at the NASDAQ does not look like a triangle to me. So, I don't know. The Dow is the only one that looks like a triangle. So just got to keep that in mind. Let's look at the US dollar. Well, this is let me pull my deal over here. Let's look at the US dollar first. The US dollar has been in a consolidation pattern for some time now. And it looks like that could continue. We could get a bounce here. Again, this looks like some sort of triangle. Whoops. Hate when that does that. I stopped in an area where it leaves a big banner there. But anyway, you can see that the triangle kind of forming here, right? And so we're expecting the dollar to reverse right in here, maybe come up into this area and then come down. So again, A, B, C, D, E, okay, and then boom, higher highs. Now, normally, lately the dollar has been, usually if the dollar's up, that means the market's typically down. But if this triangle plays out, I mean, the dollar and the market, I guess, could go higher. Anything's possible. Gold is likely to go lower if this breaks out and goes higher. And we can look at gold now since I brought it up. Gold and silver pretty much track one another. At various times, silver might be growing faster than gold, but they do track each other. So you don't necessarily have to look at, silver. Even if you want to buy some silver, you can just kind of focus on gold. Sometimes it's easier to focus on fewer charts to really understand what's going on. But you can see here gold pull back a little bit, and gold could pull back even a little further, maybe into here, before rallying into this area up here. And this is what might cause the dollar. If the dollar breaks out, you might see gold make another leg down here. And then as the dollar rolls over, then you might see the gold, kind of make its move up into here. And then all that would, gold would pull back, the dollar would accelerate out again, and so on and so forth. So now keep in mind, there's other factors, there's other currencies that trade that have an impact on gold. So it's not all about the dollar, but the dollar should give you some clue as to what gold is going to be doing. Let's look at the euro. You can see I have a triangle drawn on the euro too. The euro's, it's pretty high up here on its, it's at this trend line here. And I am expecting at any time for the euro to start rolling over and start making its way down to the other side of the triangle. And that should last many, many weeks, at least 8 or 10 weeks. And, should make for a pretty good gain if you were interested in trading the euro to the other side of this triangle. One of the more interesting currencies last week was the yen, US dollar. You can see now the dollar itself didn't move very much, so most of this move is the yen. But look at that. That's some kind of move, from here to here. I guess that was the week before last, really. And now you got this little doji forming down here. So you could get a little bounce, maybe up to there, and then another move down. And then it looks like to me we should get a pretty sizable pullback on the yen US dollar. But man, boy, has that thing been making some moves. For you guys out there that are interested in Forex, this is probably a pretty good one to trade, the US dollar, Japanese yen. Trying to think if there's anything else we should look at. Oil, we should probably look at oil. Let me pull up oil real quick. So you can see I've got a very large chart here on oil, and the guess or the analysis, it's not really a guess, because you can see the 5-wave move here. And Elliott Wave does say that after a 5-wave move, we should have a 3-wave pullback. So you can see the 2008 crisis appeared to be wave A, and then wave B was this run up here that terminated in September 2014. And then ever since then, we've been in this wave C. And if this is a wave C, we'd expect oil to pull back probably into this area here, around $16. Now I have a support area drawn here, but notice it's already been in that area. So really what I need to do is relocate my support area to below that low right in here. So maybe we don't quite make it. We might not quite make it to $16. We might only go to about 20. But suffice it to say, oil is not through pulling back, although it could very well be in a decent-sized bounce here. You can kind of see it zigzagging up, and I suspect it's not through going up. Now, we might have a lot of times when you look at these pullbacks, a lot of times this first pullback is not the only pullback. So you can see you get an A, kind of a B, and then maybe there's another C here. And then oil rallies, a little further, maybe up into this area around $46, $47, and then starts to pull back down into this area. So maybe it gets up into $50. I've got this little DP area here. This is quite old, but certainly you can see where all this congestion is here. I'd look for oil to pull back into this congestion zone here at least, around 46 before it pulls back. Now, in the near term, meaning in the next 3, 4, 5 weeks, you're probably going to see oil pull back to here and then bounce. So if you're thinking about buying energy stocks, you might want to hold off a little bit and maybe buy them around here at around $33 or $34. All right, I guess that is it for this week. I think I've covered everything I wanted to cover. There's a lot going on, but I'm trying to keep it somewhat concise so that we don't get too wrapped around the axle. There was one other thing I wanted to cover real quick, and I'll do that now. There's basically kind of a tradition around the market that says, if the financials aren't moving, it's really hard for the market to get moving. This goes again to, what's the probable direction. And so I just wanted to show you a few charts here that are, very much in bear markets. We'll go to a 2-year weekly, and it'll be easy to see here. You can see this is Bank of America, and clearly Bank of America is in a bear market. I mean, this trend is down. So, Citigroup, these all fairly, they look pretty much the same. You can see what's kind of patterning out to be a 5-wave move down. JP Morgan is probably the strongest one in the group, but still looks very bearish. PNC Financial, again, a little bit stronger, but still looks bad in the group. UBS looks bad. Wells Fargo looks bad, although not as bad. So a lot of times the market has a hard time getting going when the financials are not going. So keep that in mind too. Work that into your probability analysis, and get ready to make a decision one way or the other, because I think we're getting this is a huge topping pattern, and you just don't want to be looking. You don't want to be like a deer in the headlights when it's time to react. And here's this big topping pattern here that's been happening for a long time, and we're kind of sitting here wondering what we should do, and really the market's been telling you what to do all along in here. Any of these places in here would have been good places, although you really couldn't have. Right about where we are is about where you would make a decision to say, okay, this looks like a downtrend. And when it pulls back into resistance, which is where we are right now, I'm going to go ahead and step aside and let that train come down the road and let it pass before I get back on the tracks. So think of it like that. All right, everybody, that is it for this week's Middle Class Investor. Really appreciate you coming in and watching the videos. If you're talking to somebody and they're interested in the markets, share the link with them, the Middle Class Investor link. And, we're just trying to help people preserve capital here, trying to encourage people to take responsibility for your own money. Even if you have somebody, managing your money, don't kid yourself and delude yourself into thinking, that they're really watching out for you. That's something you're going to have to do for yourself, and that's what the Middle Class Investor is on here trying to help people do. So share that link with other people. Share the Twitter feed at Investor Class. And as long as you guys are coming in here, I'll keep coming back and sharing my thoughts with you. And until next week, take care, everybody, and have a great week. Bye-bye.